A little more than half an hour ago to the opening bell on Wall Street. Joining us right now with a look at what's going on beneath the surface of the S&P 500 and how investors should be viewing it from a technical perspective is Chris Verrone. He's partner and head of technical analysis at Strategas Securities. And Chris, it's good to see you today.
Great to be here.
All right, so your baseline, just looking at the S&P 500, we know what the headline's been. What's happening beneath the surface?
Well, let's paint the context here. We have put calls that are very low. We have sentiment that's very aggressive. We have short interest that's low. I think you have to be on guard here, but when you put it in context of the bigger picture, trends under the surface are really good.
On guard meaning, look out, we've been running so hot for so long, be careful?
Expect a consolidation or a pullback, but what do you do with pullbacks when trends are positive? You buy them. And that's really what I want to show you here. If you look at the S&P chart, you know, you broke out above that 30-50 level. There's really good support about 6-7% below us. I think that's about as bad as you do on any consolidation. We know the trend is up.
If you want to do something with a pullback, you have to wait for one to actually happen. There have been a lot of people who have been waiting for this, supposed pullback to be coming. What should you do if there's not a pullback?
You stay invested because the long-term trend is up. 75% of stocks in the S&P are in a bull market. You do not get major tops when that's the case. So let's talk about.
Do you put more money in?
Well, let's talk about maybe what's more timely. And I think EM right now is actually more timely. And if we take a look.
Emerging markets.
Yes, and this is the EEM, which basically had a bear market in 2018. You had a 40% decline. You then spent the better part of 2019 in a base. We've only just broken out here. Sentiment is less aggressive, price is less aggressive, and I think areas of the world like Hong Kong and China are just beginning to emerge here. Remember, the PMI in Hong Kong is 38, right?
Sure.
So it can't get worse from a fundamental perspective, but the stocks have stopped going down. And I also think supporting the EM call is the dollar rolling over here as well. Dollar peaked in August.
That's rolling over?
Well, let's think about this. Dollar peaked in August. We have rate differentials starting to change, right? So the spread between U.S. 10s and German 10s is compressing. I think that makes a case that the dollar is starting to turn. Look at the 50-day crossing below the 200-day for the first time in about 2 years, right? So the technical setup here is starting to change.
Yeah, all the way back here.
And then look at the message from metals. Copper breaking out, gold breaking out, EM starting to outperform. I think that speaks to a weaker dollar. So if we're looking for opportunities away from the U.S., EM is timely and the dollar helps that call. And I think one stock in particular kind of captures a lot of these themes. This is Alibaba, one of our favorite names. Another stock whose improvement recently reminds us a lot of 2015, 2016, when you were coming out of that bear market. Well, you had a bear market here as well, down 40% high to low. You've only just broken out. You get Chinese consumer, you get outperformance versus Amazon, and I think you get a really good chart. So Bob was a way to play that EM call.
Let's go back just to the S&P 500, people watching this. Because, again, there are people who have been saying, I'm waiting for a pullback. And what would you say a pullback is? Are we talking 3 to 5%?
I think anything greater than 5, right?
Okay,
it's impossible to time the 3% drawdown.
Okay, so there are people who have been waiting for this, and it's almost like waiting for Godot. What would you do? You say don't sell. Would you put any additional money into the S&P 500 ahead of that potential pullback? I
think in terms of what's most timely, look ex-US here. But let's remember, when markets consolidate, they don't always do it through price. Sometimes it's through time, right?
Right.
I think 1996 is absolutely.
We kind of watch that.
Yeah, 96 is a great example. Election year. You had a huge year in 95. You spent February through September just marking time in 96. When it looked like Clinton was finally going to win in spring and fall of 96, the market resumed higher. I think that's a reasonable roadmap for 2020. You mark time here over the spring and into the summer, and then ultimately S&P resumes higher later in the year.